Welcome back to Smart Dollar Mindset, the channel where we make money simple, smart, and actionable. Today's episode is all about clearing up one of the most common investing confusions. What's the difference between index funds, mutual funds, ETFs, and hedge funds? These terms get thrown around all the time, but very few people actually understand how they work, or which one is right for them. So let's break it down step by step. We'll cover what each of them is, how they compare, and real-life examples of how everyday people and millionaires use them. What are funds, generally? Before we jump into differences, let's start with the basics. A fund is a pool of money collected from many investors to invest in securities, like stocks, bonds, or other assets. Instead of buying one stock, you own a basket of investments managed by professionals or tracking a market index. Funds are great because they provide diversification, which lowers your risk compared to picking individual stocks. What is an index fund? An index fund is a type of mutual fund or ETF that simply tracks a market index. Think of the S&P 500. It includes 500 of the largest U.S. companies. An index fund mimics the performance of this index, automatically. There's no active manager trying to beat the market. The goal is to match it. Let's say you invest $1,000 in an S&P 500 index fund. That money is automatically spread across Apple, Microsoft, Google, Amazon, and hundreds more. No need to pick winners. Index funds are low-cost, passive, long-term growth focused. That's why Warren Buffett recommends them for most investors. What is a mutual fund? A mutual fund is a professionally managed fund that pools money from many investors to buy a mix of stocks, bonds, or both. Unlike index funds, mutual funds are usually actively managed, which means there's a human fund manager trying to pick the best stocks and beat the market. The manager may decide to increase holdings in tech and reduce holdings in healthcare. They research companies and time trades based on analysis. Pros: professionally managed and good for people who don't want to DIY. Cons: higher fees, expense ratios often 1% or more, and can underperform index funds. Long-term example. Over 10-15 years, studies show that most actively managed mutual funds underperform index funds, especially after fees. What is an ETF? An ETF, or exchange-traded fund, is similar to an index fund, but with one major difference: it trades like a stock. You can buy and sell ETFs throughout the trading day, just like individual shares. If you buy an ETF that tracks the Nasdaq, you're investing in tech-heavy companies. But unlike a mutual fund, you can sell it midday, set a stop loss, or even use it in a trading strategy. Most ETFs are passively managed, and fees are super low. Pros: flexible, low cost, and great for both long-term and short-term investing. ETFs are perfect for DIY investors who want control but still want diversification. What is a hedge fund? Hedge funds are private investment funds for high-net-worth individuals and institutions. They're managed aggressively with the goal of generating high returns regardless of market conditions. They often use leverage, borrowed money, short selling, derivatives and complex strategies. A hedge fund might bet that a stock will drop, while also holding safe bonds to protect downside risk. They can make money even when the market crashes. But here's the catch. You usually need $1 million or more to invest. They charge high fees. 2% management plus 20% of profits. Risk is much higher. Hedge funds can produce big rewards, but also big losses. They're not for beginner investors. If you're 25 years old, working a 9-to-5, and want to build wealth for retirement, an index fund or ETF is probably your best bet. If you're 55, close to retirement, and want capital preservation, a conservative mutual fund might make sense. If you're a billionaire, hedge funds are on the table. How to choose the right one for you? Here are some key questions to ask. How much time do you have to manage your investments? What's your risk tolerance? Are you investing for growth, income, or preservation? Do you prefer low fees or professional guidance? Taylor, age 30, invests $500 per month into a low-cost index fund ETF. After 30 years, she has over $600,000, even without picking individual stocks. Her twin brother Tom chose actively managed mutual funds with high fees. After 30 years, he ends up with just under $450,000. The difference? Fees and performance drag from active management. To sum it all up, index funds are low cost and great for hands-off long-term investing. Mutual funds offer professional management but often come with higher fees. ETFs are flexible, low cost, and perfect for modern investors. Hedge funds are high risk, high reward tools for the ultra-wealthy. No matter where you are in your investing journey, understanding these vehicles is key to building smart wealth. The earlier you start and the lower your fees, the better your long-term outcome will be. Thanks for watching Smart Dollar Mindset. If you learned something today, hit that like button, subscribe, and share this with someone trying to figure out how to invest with confidence. We'll see you in the next one.